Hi everyone, this is Stuart. On this week's update, we'll cover the recent pullback in markets, review valuations, discuss the importance of credit quality, and AI financing concerns. The US market has seen volatility rise in the last month with a drop from all-time highs earlier in October. Concerns from a slowing consumer to persistent inflation to AI frothiness have weighed on investor minds recently. Market weakness is never enjoyable, but we wanted to take a step back to provide context. At a 3.3% pullback as of Monday afternoon, we're still a far way away from the type of sell-off we experienced earlier this spring when the S&P 500 declined 19% on tariff concerns over the course of several weeks. While there's always the potential for a small sell-off to accelerate, we think that company earnings and economic data does not portend more serious risks at the moment, and that the nature of this pullback is healthy as it resets sentiment and valuations. Speaking of valuations, we wanted to discuss what's known as the CAPE ratio. Developed by Yale professor Robert Shiller, the CAPE ratio, or cyclically adjusted price to earnings ratio, is an alternative way of looking at valuations to give a broader perspective on whether markets are over or undervalued over a longer horizon. The CAPE ratio attempts to smooth out short-term distortions by looking at the index price divided by average inflation-adjusted earnings over the past 10 years. On that metric, we can see that the CAPE ratio at 40 is at its highest outside the tech bubble in 1999. Now, to be clear, the CAPE ratio has its critics. For one, it's been elevated for the better part of 15 years, during which time returns have been generally positive. CAPE defenders would note that the CAPE ratio is not a near-term market timing tool. The relationship between one-year real future returns, meaning returns adjusted for inflation, for the S&P 500 and CAPE valuations is weak. And when the valuation metric has been over 35, the market return over the next year has been positive as much as it's been negative. However, return correlations are much stronger over a 5-year future period. There's clearly a relationship between low starting valuations and positive inflation-adjusted returns, as well as the inverse. The higher the starting valuation, the lower the inflation-adjusted return. Unfortunately, once you hit a starting CAPE ratio of 33, 5-year forward real returns have always been negative. That's not to say this time can't be different, but we think some caution is warranted. In our opinion, one of the best and simplest risk mitigation practices investors can implement is ensuring that their holdings are not overly levered, meaning that the companies they own don't have too much debt relative to their cash flows. As you can see in this chart, strong balance sheet firms tend to outperform their weaker balance sheet cousins over time. However, in the last two instances where markets arguably became overly euphoric, in the aftermath of COVID and during the last year as enthusiasm around AI has exploded, weaker balance sheet firms outperformed as investors have been more willing to underwrite risky bets. Should there be any market correction or if the current AI enthusiasm were to moderate, we'd expect the strong balance sheet firms to outperform as their cash helps shield them from prolonged risks. Debt, in many respects, is a two-edged sword. It can accelerate momentum on the way up as well as the way down. We try to be prudent managers of your capital, and we prefer to invest in firms who manage their capital the same way. On a related note, balance sheet health is coming into sharper focus given the massive amount of capital that tech firms have pledged to spend on AI. We're not concerned about these levels of spending to the extent it's coming from internally generated cash flows and can be tied to revenue generation. In that respect, we think Microsoft, Alphabet, and Amazon are doing a fantastic job. In some instances, however, peer firms and smaller upstarts are taking on substantial debt to finance infrastructure to build out AI compute capacity in order to service customers who themselves need to take out debt to pay for using that compute capacity. This may very well work out in the long run, and as heavy users of AI, we're constructive on its adoption, but the layers of debt-dependent growth add risks that we'd rather avoid and that we think may come under increased scrutiny in the months ahead. If you have any questions about today's discussion, please don't hesitate to reach out. Thank you and have a great week.